Good afternoon, everyone. Sorry for being a bit late. My name is Hedi Zebidi, as Cathy says. I'm heading the short-term debt origination and private placement at Intesa San Paolo. And I'm very happy to be discussing this topic about short-term market with my fellow panelists, starting with Laurence Caron Habib, who is Head of Public Affairs at BNP Asset Management. Anne Wrobel, Head of Department Wholesale Market at the FCA. Mikaël, Pacot, Head of Euro Rates and Money Markets at AXA Investment Managers. He's as well Chair of the Money Market Committee at the AFG, which is the French Money Market Association. Stefano Pierini, Head of Finance and Investor Relations at Ferrovie dello Stato, Italiane. And finally, Veronica Iommi, Secretary General of the Institutional Money Market Association. So, this is about the topic today is about the hurdles and the dynamics of the money market. But before we kick in, it would be a good thing to have a quick snapshot of how big is this market. So, I hope this one works well. Exactly. So, the difficulty of this market, one of the difficulties of this market is to get data. And thanks to CMD Portal, we gathered enough data to extrapolate and have an idea of how big it is. So here we are. We are shy of a trillion, 995 billion. 66% of the market, 63% of the market is ECPs. 31%, let's say, is new CPs. And the 6% remaining is for local domestic markets. On the whole size of this, 49% are step compliant. Of course, that gives us an idea of how big it is and how important it is in the funding mix of each issuer, but as well how it integrates in the whole, let's say, investment panel for money market funds. And maybe, Veronica, you could give us a bit of your insight on that, on that size of market at the money market funds.
Yes, certainly, Hedi. And good afternoon, everyone. Really delighted to be on this panel. I think probably it's just worth, first of all, just explaining a little bit for those of you who don't know who IMMFA is. We are a trade association dedicated to promoting and supporting the integrity and development of the short-term money market fund industry. Our members consist of large asset managers, but also service providers, and a number of them you will be very familiar with and are present here at this conference. We have over €1 trillion assets under management, and our funds are sold to a wide range of investors across Europe. All our funds are AAA rated. They're institutional, and as I say, they're short-term, predominantly stable NAV funds. So we have 79% in the low volatility NAV category, 18% in the public debt CNAV category, and around 3% short-term VNAV. And I think that's just important before we go to look at the overall market. So here, you can see the overall money market fund universe and total assets under management for this total universe as of the end of March. So if we look at the blue section at the top, this represents the VNAV fund industry, which is predominantly French standard VNAV funds. The other share, representing 60% of the overall total, consists of IMMFA funds, here shown in their three currencies, with US dollar in orange being the largest, followed by sterling in green, and then euro in grey. You can see in this chart that European money market funds now have a total of over 1.7 trillion in assets under management, and that they've more than doubled in the past 10 years. Important to note that money market funds play a really important part in contributing to the real economy. They provide investors with a vital cash management tool that allows them to preserve capital whilst at the same time diversifying their risk away from single exposure bank risk. The huge pool of liquidity, looking for short-term liquid assets, drives issuance into the CP and CD markets, providing a range of issuers, including banks, governments, and corporates with flexible, cost-efficient funding. Important to note that the range of funds, both by type, VNAV and stable, short and standard, different currencies, has provided investors with choice, another factor which really goes to the industry's growth over the past 10 years, and something we really want to see preserved.
Okay, that gives a bit of the landscape, set up a bit how important the CP market is for the issuers, and as well for the money market funds in terms of optionality, in terms of investment. Now, going to the performance of the market, and I'll turn to you, Stefano. How did this market perform for you lately, and how as well do you compare it to periods of crisis, like let's say the closest one, right, the COVID one, on your side as an issuer?
Well, thank you very much first of all, for being so numerous at this time of the day and talking about this exotic product like commercial paper. So amazing. Well, I mean, I think that the market is pretty interesting. For my DNA is partially modified, so I'm a treasurer in a corporate, so it's not a financial institution. I see there is appetite. I think that it's a wonderful opportunity. We structure the use of commercial paper in a way that is combined with our architectures. We have committed lines and committed lines, so you never have the possibility of risking the refinancing of this transaction. So I look to this private debt stuff. So it's private debt 101, if I say, okay? We might dress it like this. Something which is interesting is going to complete the kind of product that a great company which has to deal with cycles, the supply chain issues, all this stuff. This is very useful. So it's a perfect combination, a perfect mix. I think that you were talking about 2020, but I think that the story, and we might see even from the graph here, which relates to money market fund, but the situation more or less was the same. I mean, 2008 and 2020 have been the moment where the market shown, difficulties. Yeah. But they are different stories. For those who are old, as I am, the 2008 is a market where a BCP was a problem. COVID was a different situation. So the issue was sort of spike in default risk, potential default risk, and liquidity risk. There's a combination which was related to the fact that, some corporates, some banks might have to deal with something completely new, so the pandemic. Yeah. So it's a different story. But the interesting story for both events, and if I say it's the lesson learned, as far as I can see, is the capability of reaction, namely the one of the US market. So in both cases, you had the CP funding facility in place. The second one was faster, was perfectly structured. And so I think one of the topics that we've been through today, the systemic risk and all this stuff, I think that the authorities shown the right way in order to deal with this stuff. And I think of those who are, whether issuers, investors, obviously we shouldn't rely on this as a commodity available. But where the dimension is so significant, I think that the market has capability of dealing with that. And then not to forget that if we look at the percentages, 80 to 85% of the market now is A1 or A1 plus. So it's a market which is referring to top-rated entities, financials, and corporates all over the world. So I'm sure that we should look at this very simple product as something that is going to be with us in an ideal mix, as I said.
Very good, very good. Mikaël, as an investor on your side, how did you live the COVID, let's say, stress scenario? And did you pull off? Did you carry on investing during that period?
It was a pretty tough period, as you can imagine. The thing is, back in 2008, 2009, it took time for the market to reassess the situation and to see spread widening. In March 2020, it was very, very fast. So we had some early signs in late February. It was ETF started to sell short-term bonds, credit bonds, to create some liquidity. So we had a kind of dichotomy between bonds and CPs. Bonds were under stress, CPs were okay. We had some inflows first, in the first 2 weeks or last week of February, first week of March. And then suddenly, we had some stress coming on, CP spread widening, some redemptions from our funds, and then it was the lockdown. So big unknown in the market. What's going on? Are the papers we are holding in our portfolios still, let's say, okay in terms of credit? You know, if you had let's say a travel agency or I don't know, a cruise issuer, it could be everything was stopped, so it could be a kind of a default. So there was some stress from that, but the major thing was the dash for cash. Everything was stopped, so market frozen, almost no transactions, and corporates and banks trying to get some funding. And then selling shares of money market funds. And I would say it happened, we had some significant redemption, close to 35% within 1 month, but it was very due to the fact that it was cheap to get liquidity from money market funds. Because if you had credit line at a bank, you had to draw this line, but you had an extra cost, while you had no liquidity fee or no swing price or no LMT, so liquidity management tool to prevent redemption from your funds. So spread widening, but not so huge when you look back at it, 20, 30, 50 basis points, while in bond market it was more 150, 200 basis points, so kind of a dichotomy between short-term commercial papers and short-term bonds. In terms of investment, for sure, we had redemption, we had to sell, so we had a cash buffer, but we had to sell, and when we are saying everything was frozen, it was not so true, or part of it was true, but still it was possible to sell paper in the market. So let's say we started with 15-20% of cash in early March. We had 35% redemption, so it means that we had to sell 10, 15, 20% of our holdings to create some more liquidity. So it was not completely dead, completely frozen, and maybe at the end, we had no default in terms of funds. Some funds have maybe had some stress or were very close to zero in terms of cash, but it was enough to go through this very difficult and hard test, I would say.
Interesting, interesting. By the way, Veronica, did you see the same on your side, on a more global scale, right? The behavior. What did you see in terms of behavior from the money market funds?
Well, certainly, I mean, you know, throughout the recent, periods of market shocks, and in particular, I'll just focus for these purposes on the COVID liquidity crisis and then the LDI crisis in the UK. First and foremost, money market funds throughout, both of these shocks continue to serve their primary purpose of protecting capital and providing liquidity to investors as and when needed. Obviously, the COVID liquidity crisis led to unusually high outflows, in response to the need for cash. We saw this particularly in the US dollar LVNAV space and also the Euro VNAVs. But it's increasingly recognized that regulation worked largely as intended in providing additional resilience, and consequently money market funds successfully navigated the storm. Then in turning to the LDI crisis in September 2022, this again led to heavy outflows from some sterling money market funds. But this was in relation to certain pension funds that were redeeming their money market funds to post margin collateral. and very much reinforced the arguments that we had also made after the COVID crisis with respect to certain pension fund investors, where we saw the same phenomenon, that if we're facilitating the use of money market funds as margin collateral, we feel would be a means of reducing the pro-cyclicality that was seen there and supporting financial stability. And that is something that we feel very much, should be part of looking at that broader interconnectivity with the short-term funding markets.
Yeah, interesting. And Laurence, based on what has been said, because of course after COVID, a lot of people were talking about regulation stepping in, helping the market, but it seemed a bit more resilient than we thought, right? Do you think that regulator has to step in a bit more in this market to make it more resilient?
Okay, so good afternoon to everyone, and thank you very much for this question. So. I think that the other speakers explained very well that at the end of the day, money market funds were quite resilient. So even in very tough periods, like in the COVID crisis or in 2022 in the UK. So it is very important to have this in mind and to take stock of the fact that there was no failure and there was no suspension. So in a certain way, it demonstrates that the regulation put in place in Europe, so the money market fund regulation, fully played its role in that kind of context. So this is the first comment I have. Now, of course, when you have this type of situation, what is most visible is the amount of outflows in money market funds. And there is a big temptation to say, so money market funds did not function properly, so we need to add another layer of regulation. I think it's not the right way to look at this situation. And probably there are three main elements that needs to be taken into consideration. The first one is that if we reopen the regulation, so probably it is necessary to have a very targeted approach and not reopening everything, and see on which aspects it could make sense to have some revised rules. So probably you know that money market funds are UCITS funds, or alternative investment funds. And these two legislations have just been revised, and there is, with this revision, introduction of what we call liquidity management tools. And in the case of money market funds, there is an obligation to select one liquidity management tool. So we already have some modification of the existing current framework that will become effective probably in early 2026, but we have already some changes with the revision of the IFMD and UCITS directive. If we look at the liquidity ratio, because this is probably one of the key elements on which we could have some discussion, so I'm talking about the specific case of French VNAV money market funds. We do not consider that this is necessary to increase substantially the level of its ratios. So for several reasons, in the functioning of these VNAV funds, we have what we call mark-to-market valuation. Yeah. So it means all variations in the value of assets are immediately reflected in the NAV of the fund. So if you have some variations, they are supported by the shareholders. And when it is necessary, we sell the assets. So for all these reasons, we do not see why significant increase of the liquidity ratio will be necessary. So the second point I want to mention is that in these conditions, and due to the functioning of French money market funds, it is very, very important to maintain the distinction we have today between the different categories of money market funds. So Veronica explained very well that there are different types of money market funds. The money market fund regulation has been developed by taking into consideration these various categories. We need to keep this differentiated approach and not consider that we should have the same liquidity ratios for all types of money market funds. Two very last short comments, because I know I have not to be too long.
I think we're the last panel, so you have the time.
Yeah. The other point is that if we modify the existing framework, it is very important to understand the consequences for the full ecosystem. And Mikaël and Veronica explained very well, so the importance of money market funds for the whole financial systems, so especially for corporates,
Sure.
Because money market funds invest in CDCP papers. They are used for liquidity needs, but also for diversification purpose. So we need to be very careful in introducing new constraints and assess what it means for end investors and corporates. Especially. And very last comment I wanted to make, we consider on our side that maybe a good way to improve the situation is to increase the transparency of investors in money market funds. Because if we know our investors, of course, it's much easier to anticipate what could happening. So it does not mean that we know each investor, but we know the major ones and the broad category of investors we have in our money market funds. So very important to have a targeted approach and a pragmatic approach by considering what could be the impact of new rules on the whole ecosystem.
Okay.
Can I just add one small?
Yeah, of course.
I was going to say that the other thing that we noted too, and I can just quickly show with this, very quickly with this graph, just to show. But this really demonstrates that the two periods of heavy outflows that I mentioned, the COVID crisis and the LDI crisis, were followed by record inflows, which resulted in money market funds quickly surpassing their pre-crisis levels. And we feel very much as well that it illustrates the resilience of the product and also the continuing investor confidence. And certainly, I mean, as you can see for IMMFA, they've gone from 748 billion euro, equivalent pre-March 2020, to over 1 trillion today.
So, thanks very much for
something
that.
happened in the market of interest rates in the meanwhile.
Yeah. So, talking about regulation, by the way, for those who are not aware, yesterday the FSB released its report regarding how to enhance the functioning and the resilience of the CP/CD market. So the timing was perfect. It was yesterday. And as well, we're lucky because we're having Anne that was co-chairing the working force on this report. So Anne, maybe you can give us some initial recommendations and policies that this report is offering us, let's say.
Sure. Please read it. Riveting read.
It's only 50 pages.
So I'd like to talk about, I'll just highlight three things. First, it was it's FSB, so it was global short-term funding market. And the microstructure, the legal context, the transparency varies incredibly, varies a lot between jurisdictions. So as regulators, we could not just have one solution or one reform that would fit everybody. So that's the first remark. The second remark was that the report says that the CP/CD market functions well in normal times, as I've heard, but also that it's susceptible to illiquidity at times of stress. But again, we did not find a silver bullet solution to address this illiquidity or the resilience, to improve the resilience of those markets. However, the reports, and I think we'll go into a little bit more detail, note a lot of inefficiencies, particularly in the operational processes and downstream post-trade of those markets, which if they were improved and if they were enhanced, could potentially help the market, if it functions well, then be more resilient in terms of stress. And the last remark that I would also draw out from the report is that it's for both the industry and the regulators to solve the problem. And we very much nudge or encourage the industry to look at solutions for the operational issues that I'm sure we'll talk about later. There has been perhaps less investments in this market, and you all know, maybe it's low margin market, etc. So there are reasons, and the initiatives were limited in scope and in impact. So we're looking at certain things that could be done together, and we'll hold roundtables, etc., to discuss that further in order to push for an improvement in the operational processes of this market. So I'll leave at that in terms of my introductory remarks.
Okay, very good. One of the struggles we have, and we saw it with the first slide, is to capture data actually, and where to go and find it. We don't have any centralized place where we can find data. So it's always bits and pieces that provide us the data. As an issuer and distributor, we have that problem. We don't know how is organized this market, how deep it is, who has what. And it's one of the struggles we're having. I'm wondering, Mikaël, if you have the same thing on the receiving side, on the asset management side. Is centralized data something that would help you work, or do you just manage to find, as you can, data here and there?
No, for sure, transparency is a key issue. The major problem to invest in the CP market, and there is an entry barrier. If you are not a money market fund manager, it's almost impossible to invest in this market. And one good example was the ECB stepping in March 2020. So a problem of liquidity in the CP market, PPP program, commercial program bought by the ECB, and it took close to 3 weeks for the ECB to be able to step in. And it was very linked to this lack of transparency, lack of data, lack of pricing. If you go to Bloomberg, you take an ISIN code, you have no information. If you want to know who are the issuers in the market, you don't really know, you have part of information. You go to Banque de France for new CP market, for example, you get the program, the outstanding, the names. If you want to go to the ECP market, you have some private providers, data vendors, but it's not accessible to anyone. So you have this difficulty. And then it also means that if you want to invest in a portfolio, credit bond portfolio, govies portfolio, because you think it is of interest for your portfolio, then you have to do some mark to model because you have no prices. If you want to enter a trade in your front office system, you need to have a specific tool. So on our side at ICMA, we had to develop a specific tool for the trading of money market instruments, because you don't have your ISIN code that is created from scratch. So you don't have the information linked to the CP, like the sectors, rating, the maturity, and so forth. So you have to create everything, send the trade to your trading desk. Then you have to wait, and then you have to create a temporary ISIN code, and so forth. So it takes time. Then you have to evaluate on a daily basis. You don't have the pricing sources. So it's a real pain to trade these CPs. And that's true, and it was well highlighted in the report. Access to data. What is your outstanding amount? Who are the issuers? What are the maturities? Volume of trades daily, for example, is something of importance. And we also have to, by regulation, the IMMFA regulation asks us to do some stress test on liquidity. So if you want to know how much you can sell in the market per day, if you have some redemption, you have to assess your market share, how much you can sell in the market. And then if you don't have data on that front, it's a kind of a guess. So it's a problem versus how can I sell OATs, bonds, treasuries in the market. You've got data. So that's something very, very important. And I think it's one of the key hurdles to broaden this market or get access to more players.
Okay.
Can I react to that? I have a question, actually. So I have 3 remarks. Number one, it's not just about pricing. Pricing is super important, but the basics, like what is the outstanding amount of an issuer, etc. Not even that is there. So I was just thinking, we're saying, let's start also with just having the basics, if possible, or the profile of the investors, etc. But also the pricing, obviously. That's my first remark. My second one is and we're going to talk about it, is that because of the ISIN problem, and I'm sure we're going to talk about it again, because of the time it takes to have an ISIN, all those processes post-trade, STP is not available. If you don't have STP, you don't have trading on platform as much, or execution on platform as much. But if you do have execution on platform, then the platform starts having a rich data set, and then when you have a rich data set, then you can have data that you can distribute. So maybe to get to the transparency, we just have to start with the basics, which is let's solve this ISIN problem to go quickly to have STP. And the third one is the report is saying that we're not quite sure whether having more transparency would necessarily open up to new participants in the market. As you know, 75% of the CPCD market in Europe is in the MMF, while it's 25%, I mean, in the US or something like this. So it's much, much more diversified in the US than it is in Europe. So we were thinking in our group, you know, what can we do to diversify the investor base in CPCD? So the question is, and we said, and I know that you disagree, so that's why I wanted to ask you the question, if we have more transparency, does that really will attract new participants, other kinds of participants, which could be potentially counter-cyclical to the MMF, for example? So it was ambiguous in our outreach.
As an example, I'm heading money market, but also rates and insurance team. We do manage some short-term total return mandates, defensive one, like 0 to 3 years or 5 years. And then one of my colleagues came and said, the curve is inverted, spreads are pretty decent, I've got to deliver something above Euribor. Then why not buying some commercial papers? And we worked on it, and we did some. This fund manager had never invested so far in money market instruments. It was a real pain. So first we had to adjust the prospectus, because most of the time this type of funds don't take into account the fact that they could invest in money market instruments, or it's very limited to T-bills. But then you look at the current situation, inverted yield curve, 4% when you invest below 1 year. You go on the 2, 3, 4 years, you've got 2.5 or less. Spreads are pretty decent. So why not? As a fund manager, you have to look at what is the best for your portfolio. So at one point, maybe it will be worth adding some duration, going on the 5 to 10 or 20 years. But last year, for example, it was not bad to stay pretty short. And then the only thing is, if you don't have a team in-house with the tools, with the expertise, you can't do it. And then we had to set up kind of a carve-out in the fund, so delegate a pocket of this fund to the money market team. Because we have it. But if you are a small player, not in money markets, you can't. If you are a hedge fund, not playing on money market, if you have a crisis and you've got 5% on short-term papers, maybe it could be worse having some for a while. So I would say there is no reason why, if there is a kind of a bargain or a source of alpha, you wouldn't buy it. But so, and what is different during COVID, we were at sub-zero levels, so negative interest rates. So even if your spread had widened, it was even better to buy 2 years, 3-year paper at 200, 500 basis points or longer credit. Current situation is quite different, so I would say, depending on the market context, it can be very, very attractive.
It's true that for one of the simplest, supposedly, products, you have less data than private placement on credit. And that gives us at least a picture of how cumbersome it is, actually. And coming back to the icing point, icing makes the post-trade longer than the trade itself. That's where we are here, right? Exactly. And if you start going into local markets, it's another story. We're talking about giving up in a way sometimes, right? So I join you in that point, right? Which is, again, we're talking about one of the simplest products after deposits with the less transparency, liquidity, and process easy landscape. So it's quite, I'm joining that. Do you have any, by the way, other points you'd like to share with us, actually?
So we had a lot of different ideas about how to improve, but none of them in itself were game changer. So we talked about digitization, for example. Why is it not happening in this market? We talked about shortening the T0 for this market, although there was some complication with the FX. You would have to move the FX as well, so that makes it a little bit complicated. We talked about harmonization of the way the interest is calculated, for example. But so there was a lot of ideas which, when we were looking at them, was like, well, that seems obvious, right? That should happen. In itself, I don't think that will move the dial in terms of making those markets really more resilient. But I mean,
it's a step-by-step.
It's a step-by-step, yeah, exactly.
It's a commitment that all has. We must take. Think about the kind of information, even though we are not talking about secondary market prices. But if you compare the pages from Fed with the one from STEP, you see. So you don't have that. The greatest part of the non-available information is there. So it means that the whole system is not providing and granting a higher status, if I may, to the product, which I think is something that each of us should be thinking. But it's true what you say. The Heisen process, it's definitely something that you have to deal with.
It's already a hurdle, in a way.
You have wonderful back offices, which is something that
exactly.
Don't give it for granted.
And by the way, just getting back to this point, we're talking about all the hurdles we're having in this market. Laurence, do you think that it's achievable to simplify all this in a way, to make standardize this market a bit more? And what would be needed? I know it's a big question, but what would be needed to get there? Even a little step, right?
Maybe you could ask the question to Anne as well, because I think what the objective of the FSB report was to look at this point as well, capacity of standardization or not. And I understand today, so I understand that the conclusion is that nothing is easy and could be taken isolated as a game changer. So probably the answer is no. I guess the answer is no. But I think that the point is about data again, and as long as we do not have data, it's complicated to make some progress. Maybe another point is the fact that the issuer industry is not as much federated as other ones. So if you take the financial sector, so asset management community, banking community, so you have these people very active in trade associations and this kind of things. In the issuer world, I'm not sure you have this kind of
Not the most fashionable topic, but...
Yeah, and as it is very fragmented, and you have...
But for those who have big SAP programs, for instance, that this is a commitment that they're doing. But think about how many pages in the last 2 years Bloomberg has released in this respect. So the OCP, the EPX. So there's information, but obviously you have to put the number, so and it's clear. I think that. Sorry, because everybody's thinking about this direct issue and all this stuff. I think there's an important role they do have also the dealers, which is a market which has not so many dealers like the bond market. So the dealers, for being the reference one, I think they're seriously committed to do that. But it's clear that it's a dialogue that I think you have every day with your clients, and this is something that we are surely look in this direction. I think it's a market, the one commercial paper, that has its own standing. Obviously, if you want to have the same information that you have on government T-bills, that's probably something that it's not deliverable as it has been clearly addressed in the research.
And Mikaël, maybe you wanted to add something.
One comment. It's a low-fee market. It's not a very big market compared to other instruments like bonds or govies. So at the end, there are not so many people, and I would say dealers and banks, ready to put too much money in the system to improve it. Also, by nature, it's more a buy and hold market. So secondary market exists, but it's pretty thin. And I would say it's rather binary. So in normal times, no need to have some secondary market. But when you have some stress, suddenly you have a strong pickup in demand for secondary bids. And then market is not ready for that, not prepared for that. Dealers are not, or banks are not keen to take too much paper on their balance sheet. So at the end, it's because of this biannual nature and binary, volatility on the secondary market that maybe causes some problems. And it's pretty hard to bring some secondary or new market players because of that. If we had some more turnover in portfolios, maybe a broader market, it would be okay. And when you look at figures, we've got 1.7 billion of money market funds, 1 trillion of CPs, new CP papers. So there is kind of imbalance. So we have cash. Let's say there is cash. The complement is cash in money market funds, not only but or T-bills. But I would say there is kind of imbalance. And if we had some new players coming in, we would have kind of a squeeze in the system. So also something to have in mind.
Yeah. Thank you. Conscious of time, I will move topic to another one, a new one, which is the potential reform on the money market funds. And of course, I could start with Anne asking you again, because you've been we know that the regulator have been working on this topic, possibly. But I'll turn to Veronica just to relieve you a bit from an extra topic to talk about, and we'll come back to it and have your opinion on it, of course. Veronica, what's your opinion on using money market funds as collateral for centrally cleared derivatives?
So, I mean, we think, as I mentioned, this is really, an important feature and something that we see as a kind of low-hanging fruit in many ways, in enhancing effectively the short-term funding markets more broadly and functionality, especially in times of stress. It is more a question of changing regulation, making some small changes to the regulation. So, as I mentioned, if we allowed money market funds to be posted directly as collateral, this would avoid that situation where you have investors that, such as pension funds, as I mentioned, using money market funds as a store for cash and, to redeem them for margin calls, but then having to redeem them to post cash collateral, which then gets reinvested effectively into other money market or short-term money instruments, and sometimes often back into money market funds themselves. So, that creates additional systemic pressure on what can be, stress scenarios. And we feel that is one area that we're delighted to see, is for consideration.
We have consulted on allowing, and actually we are allowing for non-centrally cleared margin to use MMF, and I know that there is some more things that needs to be done, but
I think the difference being is that the non-centrally
it's non-centrally cleared.
There are haircuts with that, and the treatment of money market funds as equity as opposed to debt. So that is what sort of makes that prohibitive in many ways. And then obviously in the cleared sector, that is currently not permitted in Europe. It is in the US.
Correct.
And obviously is beneficial.
Okay. Interesting.
Yeah, I have a quick comment on that. So, of course, this is something we have a look at. And we consider that it could be an option. But in that case, what would be very important is to review, I would say, the CCP model and ensuring we have sufficient diversification rules, because if you don't have this type of diversification, it could add some vulnerability to money market funds. So it could be an option, but you should have, I would say, as I said, minimum diversification rules to make sure that all collateral is not made only of money market fund shares. So why not? Sense, yeah. But of course that needs to be reviewed carefully and with the appropriate safeguards.
To add on what Laurence said, discussion, at the Money Market Committee at AFG, no consensus. So we think it could be good to look at it, and also at EFAMA level we had some discussion. But I would say, for sure, it should reduce pressure for redemptions. Because, as you said, Veronica, instead of selling money market fund to get cash, to send it to the CCP or for collateral management, then you can just transfer your share of money market fund. So maybe good to alleviate this risk. Now we have to see the global environment, make sure that you don't lose some kind of signals. So at one point you have stress in the market, you need some more liquidity collateral somewhere, nothing happening on money market fund, no redemption, and suddenly you have kind of a cliff effect, and then you have to sell. I would compare it to a certain extent to ETF. So you have shares, floating shares quoted, so you have some buy, sell, with the trader, and then suddenly they have to redeem and they have to sell assets. Yeah. So we have to be very careful, but money market fund have the features, I would say, for that. They are daily liquidity, they are regulated, they are very defensive, low volatility. So at the end, they have some attributes to be eligible for that.
Okay. Thank you very much. I'm aware that we're over time already. Of course, we could carry on for an hour and a half because there are so many topics on this. But just to conclude, I'll just go through the whole panel, asking you first how you see going forward this market, and second, if you had any wish for this market in terms of optimizing it and making it more efficient in a way. I'll start with from the farthest to the closest to me,
okay,
the
so
laws.
You're talking about CP, CD.
Exactly, yes.
Yeah, I would say that data and transparency are definitely the key priorities, to be very short.
Okay.
Same, and to achieve that, perhaps getting rid of the inefficiencies in the post-trade, like to allow STP would be really, really good.
Okay.
I would say money markets or short-term markets are not dead. We've gone through 10 years of negative yields. So we are still there, and now we've got 4%. Even if the ECB cuts 3 times this year, maybe, and a few next year, we will still remain at pretty decent, attractive levels.
That was called high yield before, right? 4%.
Yeah.
Right.
So at the end, I would say assets under management should remain pretty elevated in the asset class. Maybe lose a bit if we have some rate cuts, but still at high level. And then need for investing in CPs will be there.
Thank you. Stefano.
It will be. I think I already said in another meeting, but CP has been the first product that I did in 1992 when I entered into a dealing room. So it's here to stay, I guess.
Yes, clearly. And Veronica, we finished with you.
Well, certainly agree that it is important that some of the barriers we've mentioned in terms of transparency and also lack of consistency in the short-term funding market ecosystem are addressed to the extent possible, and that include also enabling money market funds to be eligible as margin collateral. Likewise, in the context of money market fund regulation, that any changes to the regulation result in targeted, proportionate reforms which further enhance resilience of money market funds, but which are beneficial also to end users and also to the broader financial stability as well.
Okay. Thank you very much. Thank you very much, all of you, for your input. Thanks for your presence. If you want to discuss further on this topic, we're available after this panel. And applause. Thank you very much.
Thank you very much.